Hi everyone. Volatility is now everywhere, and fixed income markets cannot catch the breath fast enough. Sovereign yield curves get distorted one way or another, and central banks look lost between inflationary pressure, currency wars, geopolitical tensions, and erratic budgetary decisions. On the investment grade side, corporate bond yields continue to rise sharply as a result of higher risk-free rates and higher spreads. The whole IG market is driven by flows rather than fundamentals at the moment, and investors look reluctant to engage more as volatility remains too elevated. We have a preference for non-financial companies in defensive industries, and we continue to favor front-end maturities, as we are witnessing more and more profit warnings from cyclical companies. Let's address high-yield markets now. The rapidly weakening macroeconomic outlook has yet to impact the fundamentals of issuers, and we are waiting for the next round of quarterly results to see more reflection of how supply and demand dynamics may impact this universe. We expect more decompression to come between rating segments, with BB rated bonds outperforming single B and triple Cs. We keep our preference for US-based companies within this universe, whose fundamentals could benefit from better macroeconomic conditions than in Europe. Let's now turn to subordinated debt. Most bonds trade with unprecedented price discounts, as extension risk is more or less priced everywhere and has magnified the yield impact on these bonds. The average yield to call of euro-denominated AT1 CoCos now stands at around 12%, which is much higher than that of high-yield indices. Fundamentals should remain intact in our view, but again, credit markets trade according to the perceived intrinsic beta and technical aspects rather than historical or expected credit metrics. We hold the preference for USD-denominated AT1 CoCos from core European and Asia-Pacific banks, which usually remain more resilient amid difficult market conditions. As a conclusion, market conditions are set to remain difficult for the time being, as we do not expect volatility to fade away for the months to come. Thus, we keep our defensive stance on all fixed income credit segments. Thank you all for your attention.